Hi everyone, welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. Today, let's dive straight in. We're looking at a very interesting company, one that's been getting a lot of press recently, especially since Facebook announced its name to Meta, and this company is squarely within that realm or that field. So a company called Roblox that we're going to be looking at. Now, Roblox are an online gaming platform and a game creation system. Now, what's interesting about them is they are, especially the CEO is talking a lot around the meta world. So the augmented reality, virtual reality, there's a huge amount of implications when it comes to brands advertising themselves on such systems. Now, we're going to look at the finances today. And before we do so, don't forget to like, share, subscribe. If there is a company like this that you would like us to analyze for you, do leave a note in the comment section and we'll get onto it. So a bit of context around Roblox. You're not going to see that manifested in the numbers today because we're backward looking with these financial statements. However, it is good in terms of the context that you should be looking at, particularly if you're including this in your investment thesis. So a few things to note about Roblox. Number of active users. So some of the good things that they have, number of active users that they have, the average engagement rate of those active users is 2.5 hours. And that's pretty significant when you think about the attention that you can command on this platform, particularly for brands that might wish to advertise themselves on this platform. So that's an important point. The other thing to note is that the average bookings, I'm still looking at my notes here, the average bookings per day from active users is around about $15.41. And that was something they announced in the quarter ending June. Now, what's important there is that's an important metric because we want to see that grow as investors. However, when you look at that compared to the prior year, there's a slight increase, but year-on-year comparison, it's a slight decrease. So that's an important metric to look at, and that should form part of your investment thesis. A few concerns, not concerns about the company, but certainly metrics you should look at that are important. And one of the main ones is the average users that they have are ages 13 years or under. And kids can be very fickle. Trends change, what's cool and what isn't can change very quickly. So that is an important thing to note when you're looking at a company like this, whether you're thinking about investing in them, or even if you're thinking about doing business with them. And this is part of your research and part of your statements with them. So we're going to look at the finances today. Certainly the share price has taken a significant increase, almost a vertical increase since 8th of November. Very similar timing as well to when Facebook announced its name change. So stick around as we're going to cover that later on. So Ted, let's share with our viewers what we found out about the finances and really help them kind of understand how they can analyze future finances from this company as well.
Absolutely. So good to see you, Moeed, and welcome to all of our viewers. Once again, as Moeed mentioned, this is looking at the financial statements. We're going to be looking at, in fact, the only financial statements we can find are their third quarter, which are available on their website. Here they are. So you can't even print them off. You actually have to go and look on their website. And if you, we're looking at it from a financial perspective. If you'd like to add anything that you know about this company, about the opportunities, about the deals they've signed or about to sign, pipeline business, anything like that that you think is going to add value, then please do use the comments section. So what do we see going on? Well, there's a little bit of commentary there, but we're going to jump down to the actual numbers. So here we see the actual numbers, and what we're looking at, we're going to look at the 9 months. And if we look at the 9 months, we can see the top line, the revenue has increased significantly, 120%. Okay, so rapid and very significant growth going on for this business on a top line. And if we project that out, a very rough back of the envelope calculation suggests that we are looking at a 1.8 billion. So you'll notice that this is in thousands. and so 18 million is 1 billion. So a pretty substantial sized business. Cost of revenue gives them a gross margin of about 74%. Okay, so there's the cost of revenue, the cost of what they're actually selling, cost of this service. Now, I don't know exactly what is in there, but you'll notice there they've given you a little indication. They say note number 1, and down the bottom they've given you note number 1, depreciation of servers and infrastructure equipment included in infrastructure and trust and safety. So in effect, you know, the cost of the revenue is in effect the the depreciation of the system that they're using. They've then got developer exchange fees. So this is where the people who are developing on this platform, these are the fees that are actually being paid to them. They've got some more infrastructure costs, R&D, and then the SG&A, the general administrative sales and marketing. So costs are relatively high, leading to an operating loss. Okay, so we can see the operating loss has increased. The overall costs have been increasing as well. Interesting enough to see the cost of this revenue increasing. Let me just clear those so we can see that. So this cost of revenue, so if that was a depreciation, pure depreciation, we'd expect that to be relatively stable. So it looks like there's investment going into the platform, and then the depreciation is going up. So at some point, we're looking for a break even. The operating profit margin is staying constant at negative 26%. Sorry, it has improved slightly from a loss margin of 32% to a loss margin of 26%. So it's going in the right direction, but they still need to continue to scale in order to, you know, hit that kind of magical bottom line profitability. So looking to kind of, you know, to increase that, but if they're growing at 120% a year and they do that for another few years, then that should be easily achievable. So there's the income statement. Very quick look at the income statement. If we go to the balance sheet, in terms of the assets, what we notice is this company is stuffed full of cash, lots and lots of cash sitting on the balance sheet, $2 billion worth. And it looks to me like that's probably a big increase in cash, making a loss, quite possibly some kind of fundraising, and we'll just confirm that a little bit later on. Obviously, they did a flotation. That's where a lot of that cash would have gone. However, what's also interesting about this is this line here. Now, this is something you don't often see. So here, I just want to highlight out that we've got this deferred cost of revenue. So if we think about costs of revenue, that's the cost of providing the service. What they've taken is some of that cost, and they said, we're going to recognize that cost not this year, but next year and the year after, et cetera, which is quite interesting. So that's kind of looking at kind of deferred depreciation, which is, you know, the kind of the cost of the actual system that they're providing. So they've got some property, plant, and equipment in there. They've got some operating lease, and then there's also some goodwill where they have clearly been, you know, buying other systems or buying other companies in order to plug into their system. So the balance sheet is increasing, a significant increase, 3.2 billion on 1.8 billion at the end of last year, i.e. the beginning of 2021. If we go down to the liabilities, just to scroll down to the liabilities, what's quite interesting on the liabilities side is so the total current liabilities. So liquidity doesn't really look much of an issue. We compare the current liabilities to the current assets. You remember that's all about, can the company pay its bills on time, and it's stuffed full of cash, so I'm not too worried about that. But what is interesting is this number here. This is the deferred. This is the current portion of deferred revenue, and also this number here, which is the sort of the non-current portion of deferred revenue. So deferred revenue is where you are receiving money in today, but you're not providing the service until a future point in time. So this is effectively saying that so far this year, they've received 1.6 billion in revenue, but the actual service that they're providing to the customers, they're going to give next year or within the next 12 months. And some of it even relates to even longer than that. Now, I haven't looked in detail at their business model, but that looks to me like they're selling quite long-term subscriptions. So maybe they're kind of selling a, buy 5 years worth of opportunity to use it. Maybe they're kind of buy 5 years today and we'll recognize it over the future 5 years, for example. So they're giving you a discount on a 5-year membership rather than just a single year membership of this platform, or on a pay as you go. So quite interesting, just looking at those numbers, and what that suggests to me is that they're going to have very, very strong cash flow as a result of that. So this, what we're really seeing here is that the revenue they receive today that relates to next year and the subsequent years, we can match to a deferred cost of revenue, i.e. that's this number here, the cost of revenue, and the deferred cost of revenue current portion, this number here. So we match these two together in terms of this kind of, they're deferring revenue and therefore they're deferring the cost of generating that revenue. So just quite an interesting, we don't often see that in a business. These are non-cash items, i.e. the cash has come in, they're not going to have to physically pay stuff out in the future. So again, it's more accounting for timing rather than a liability that they're going to physically have to pay out. So that's kind of the balance sheet, bottom half of the balance sheet. Just to highlight that there's not really any debt, there's no interest, but what we do notice is that the balance sheet has gone from being negative last year and it's gone to positive this year. And one of the big reasons is that this convertible preferred stock has now converted, and also they have raised a whole lot of extra cash through their flotation. So what we see here is that from 239, so 239 or 240 million up to 1.4 billion is partly this conversion of the 345 million. And also additional funds coming into the business, and that is going to account for a proportion of that increase in cash. So let's go through the we can see that in the cash flow statement. So the cash flow, as we predicted, they are making a loss, but they have very strong cash flow. So very good, strong, positive cash flow coming through. And that cash flow is really driven, in part by receiving money, this deferred revenue, effectively receiving money in advance. So you could see that this number here coming through, very, very strong deferred revenue. So money paid today for a service that they're going to the clients are going to receive in the future. And also you'll notice that there's quite a lot of stock-based options. So we're paying our staff, but we're paying them in stock rather than physical cash. So lots of people with skin in the game hoping to make their little fortunes out of this. If we scroll down a little bit further on the cash flow, we can see that there's a little bit of investing going on. So property, plant and equipment, and also business combinations. You remember we've got goodwill sitting on the balance sheet. We've got goodwill. It means that they're growing by buying other business. 46 million pounds spent on other businesses, which they're kind of plugging into their platform, into their offering effectively. And then we see down here, here is the kind of, there's the effect of the IPO. So a very significant raising of cash when they went through their flotation. And so therefore they are now sitting on 2 billion of cash at the end of the year. So very, very strong in terms of their cash flow. So there we have the finances of this business. Quite interesting. It looks like, it's not profitable, but it looks like it's going to become profitable. There's a scalability aspect to it. It's very, very strong cash flow. It's raised money through the IPO, so I can't see it going back and begging for more money unless it really wants to kind of ramp up its expansion plans. if we go and look at the actual the share price of the company, there's no P ratio because there's no E, there's no earnings, no dividend, of course. You mentioned this kind of this price spike, and there it is. It jumps out at us that, suddenly, there's a lot of people got very excited by this, and a few people would have made quite a lot of money out of that if you've managed to crystallize that. What's interesting though is that this is a $72 billion company, so $72 billion in terms of the market cap. And don't forget that when we're looking at this business, we've got a balance sheet of about 600 million. So your 600 million of assets, you're paying 72 billion. It's basically all goodwill. It's all the future. So this is very much this is a good news company, but it's all baked into the price. And I would suggest, perhaps maybe even there's too much baked into the price. So you're only going to need a little bit of bad news for this company then to suddenly, the share price to wobble and start to come down. Now, I don't think that the company itself, the company itself in terms of its financials are strong. Again, going back to their break-even analysis, if they can break even, and also making sure that deferred revenue is not a potential Achilles heel. So of course, if I go to the market and I sell 5-year subscriptions today, for example, then I'm not going to get any revenue for 5 years because those people are going to be paying for free as far as they're concerned. So I just need, again, it'd be interesting if anybody knows about that aspect of the business model. We start to think about, the deferred revenue compared with the actual sales itself. So, it's worth just thinking about. We go back to the numbers. Let me just clear that annotation. So if we go back to the numbers and we think about the revenue, so you'll notice the revenue here is for the 9 months 1.3 billion, and the deferred revenue, if we scroll down into the balance sheet, we see the deferred revenue. Oops, go up to the balance sheet. So the deferred revenue is 1.6 billion. Okay, so that's quite interesting again. So it looks to me like, most of the, there's a lot of revenue recognition, but there's a substantial amount, if that deferred revenue was a small proportion of the revenue, it means that they're kind of making sales each year. So this company, it kind of depends on continued growth. And Moe, just to reiterate, the point that you made, if they're in that kind of 15, 16, 13-year-old market, it's a very fickle market, right down the bottom in terms of the teenage, the little tweenies and the very young kids, the parents are telling them what to do. The older we get, the more kind of we just stick with what we know. But a very fickle market. Suddenly they could find that actually, those revenues dry up as the new great thing comes in, because they haven't managed to keep up with the development of this metaverse that we're talking about. So to me, it's kind of, solid company, pretty good financials. However, would I buy in it? I certainly wouldn't buy in at that price. I think it's a very expensive stock. And don't forget, Jam tomorrow's stocks don't like inflation either. So there's going to be quite a few headwinds for a valuation like this.
Yeah, really good analysis. And one part that I forgot to mention as well, because you talked about risks, another risk that's worth noting, whether it's a significant risk or not, that's something further to be analyzed. But Vans, for example, paid quite a bit of money to have their product showcased in one of their games on their platform. And we all know the ethics behind advertising to young children. There's a lot of media around that. There's a lot more restrictions and questions coming up about, the ethics around that, and companies are being placed, there's pressure being placed on them. So that could also factor in as part of the potential for this business, right? If there's a sudden change or a bit more restriction, regulation in that area, that's obviously going to impact Roblox's potential for revenue growth. So worth including that in investment thesis. Ted, that was a really good analysis. I certainly think, in my opinion, this is my opinion, definitely an expensive stock right now. But let's wait and see how it develops. So thank you, everyone. Thank you, Ted, and we'll see you on the next video.
Okay, good to see you, Moeed. Catch you later.